Assalamualaikum to our beloved lecturer, Professor Madya Dr. Rahimah binti Muhammad Yunus and my fellow friends. Today, we from Group 6 will present on topic New Mfrs, Mpers and Mpsas. I am Nurdini binti Muhammad Says and my group members are Nur Elisha binti Shamzul, Nur Faraniza binti Muhammad Hisham, Nur Liana Azwah binti Nur Azam and Nur Ridahani binti Irnal. In Malaysia, companies registered are required to prepare statutory financial statements in accordance with the approved accounting standard issued by the Malaysian Accounting Standard Board (MASB). The same goes to foreign companies listed on a stock exchange in Malaysia. They may prepare financial statements in accordance with certain internationally recognized accounting standards such as International Financial Reporting Standard (IFRS). MASB is established under the Financial Reporting Act 1997 as an independent authority to develop and issue accounting and financial reporting standards in Malaysia. So basically, MASB has three sets of approved accounting standards that is applicable in Malaysia, namely Malaysian Private Entities Reporting Standard (Mpers), Malaysian Financial Reporting Standard (Mfrs), and the third one, Malaysian Public Sector Accounting Standard (Mpsas). So both Mpers and Mfrs are issued by MASB. Only Mpsas is issued by Accountants General's Department and it is the latest accounting standard being established between these three accounting standards. So although the different accounting standards have different scopes and users, but the goal is the same. Such accounting standards aim to provide financial information to investors, lenders, creditors, contributors, and others to help in making decisions about providing resources to the entity. But what is actually Mpers, Mfrs, and Mpsas? Malaysian Financial Reporting Standard (MFRS) framework was introduced by the Malaysian Accounting Standard Board (MASB) and came into effect on 1st January 2012. It is fully compliant with the International Financial Reporting Standard (IFRS) framework, which enhanced the credibility and transparency of financial reporting in Malaysia. The adoption of the MFRS framework was a significant milestone for the capital market. Entities can now assert that their financial statements are in full compliance with the IFRS. So there are altogether 42 standards covering all relevant areas for financial reporting by non-private entities. Move on to the next standard. Malaysian Private Entities Reporting Standard (Mpers) was issued by the MASB in February 2014, marking a new milestone in Malaysian financial reporting of private entities. Mpers is practically identical to the International Financial Reporting Standard (IFRS) for SMEs set by the International Accounting Standard Board, except for the requirements for those involved in property development activities. Mpers framework is effective for financial statement beginning on or after 1st January 2016 with early application permitted. Last but not least, a little bit about Mpsas. To oversee and manage the development, assurance and implementation of Mpsas, the AGD of Malaysia has formed two committees which are the Government Accounting Standard Advisory Committee (GASAC) and the second one, the Accrual Accounting Steering Committee (ACSC). So it is drawn primarily from the International Public Sector Accounting Standard (IPSAS) issued by the International Public Sector Accounting Standard Board (IPSASB). So there are currently 35 Mpsas standards issued by the AGD. Federal Statutory Bodies (FASBs) determines that its dates of adoption of Mpsas is on 1st January 2018. That's all from me. I will pass to the next presenter.
Thank you, Dini. Now, my name is Nur Faraniza binti Muhammad Hisham and I will explain why there are different standards for different types of entities. As we know, there are various types of entity of a business. So there's accounting standard is being created to meet all of the criteria of the entity. First, I will explain about the Malaysian Financial Reporting Standard or MFRS first. MFRS is developed for non-private entities that are required to prepare and lodge their financial statement with the Security Commission and Central Bank of Malaysia. Entities other than the private entities shall apply the MFRS framework for annual reporting for annual period beginning on or after 1st January 2012. MFRS are designed to apply to the general purpose financial statement and other financial reporting of entities under the purview of Section 26D of the Financial Reporting Act that do not meet the criteria of private entities. The general purpose financial statements are directed toward the common information need of a wide range of users, for example, shareholders, creditors, employees, and the public at large. The objective of financial statement is to provide information about the financial position, performance, and cash flow of an entity that is useful to those users in making economic decisions. Next is Nigerian Private Entities Reporting Standard, or Mpers. Since MFRS is not fulfill the criteria of private entities, Mpers has been developed by MASB to do so. Mpers is developed for private entities has been launched on 27 October 2015. Private entities are required to apply the Mpers on the financial statement starting from 1st January 2016, but early application is permitted. Mpers is an adaptation of the International Financial Reporting Standard for small and medium-sized entities issued by the IASB in July 2009. This IFRS caters for the financial reporting of small and medium-sized entities that typically do not have complex business transactions and instruments. The requirement and guidance in Mpers will generally be sufficient to small and medium-sized private entities in Malaysia. Mpers does not come with detailed application guidance in some complex areas. Larger private entities may need to refer to the guidance in the MFRS framework for their accounting requirement. A private entity could also option to adopt the MFRS framework. All private entities which adopt either Mpers framework or MFRS framework must adopt the framework in it entirely. Larger private entities may need to refer to the guidance in the MFRS framework for the accounting requirement. For some larger private entities, they may find adopting Mpers a disadvantage because the option of capitalizing development costs or borrowing costs has been removed and purchased goodwill must be subject to annual amortization. They may option to migrate straight to the MFRS framework. The adoption of Mpers is partly a response to the recommendation by the World Bank's report on the observance of standards and codes (ROSC). The World Bank recommended that the review of the private entity reporting standards, which are based on 2003 version of international reporting standard, to be given priority as they are outdated, and the changes to the accounting standard and reporting framework should be based primarily on the needs of the users of the financial statement and public interest consideration. The board believes that Mpers meets the World Bank recommendation as it is primarily based on the IFRS for SMEs, which was developed by IASB and does take into account the needs of non-listed entities in Malaysia. The third one is Malaysia Public Sector Accounting Standard, or Mpsas. Mpsas is the financial reporting framework issued by the Accountant General's Department (AGD) of Malaysia. The Mpsas are designed to apply to the general purpose financial report of all public sector entities other than the GBE. Public sector entities include the federal government, state government, and the local governments. The AGD believes that the adoption of Mpsas, together with the disclosure of the compliance with this regulation, will lead to a significant improvement in the quality of general purpose financial reporting by the public sector entities. This, in turn, is likely to strengthen public finance management, leading to a better informed assessment of the resource allocation decision made by the government, thereby increasing transparency and accountability. The AGD strongly encourages the adoption of Mpsas by all public sector entities towards enhancing the quality and transparency of public sector financial reporting by providing better information for public sector financial management and the decision making towards achieving enhancement of the quality public services. I think that's all from me. I will pass to the next presenter.
Assalamualaikum warahmatullahi wabarakatuh. My name is Nurliana Azwa binti Nur Azam. Next, my explanation is on the challenges that are faced by SME for the framework adoption. Mpers has been targeted to the SMEs that do not have public accountable entities. So, it is a responsibility of the government of the respective countries to decide the type of businesses that should adopt according to the requirement. The definitions given by IASB for SMEs include the non-publicly accountable entities, such the corporation in which their shares are not publicly traded and they are also not a financial institution. The other entities that may adopt this standard include the company that is fairly large in terms of their size and also their value, subsidiary of a listed company if the subsidiary is a non-listed company, and a public utility. Thorough evaluation and analysis should be performed so that none of the business groups and also entities are excluded, thus making this compliance with the standard not fair and applicable only to a certain group of companies. Hence, the first challenge faced by SME is compliance costs. The company that adopts this standard must also ensure that its financial statement at all times comply with the standard. So, a mechanism must be created to ensure this compliance. New mechanisms such as auditing, internal audit and internal control mean more money will be spent out of the company's pocket. Many business players believe that by having this standard, more rules and regulations will follow after this. Hence, the best bet is a possible requirement for the financial statement to be audited by the licensed public of accounting firm. Majority of the participants of the survey conducted by ACCA in the year 2008 indicated that their current audit fees would increase with the adoption of the IFRS. Compliance with the standard is said to be useless and incomplete if it does not receive third-party assurance. So, the reliability of the company will be at stake if the conformity of the financial statement that is free from biasness, error and also fraud are missing. Second is accountant for SMEs. There must be a supply of the accountant that has a sound knowledge on the standard. By employing a full-time preparer in the long run will also benefit the company, as the knowledge and unique features of the company will be nurtured in the hands of the internal staff and also prevent the secrecy and the jewel of the companies lost to external people if they hire a part-time accountant. By outsourcing the work of preparing the financial statements is costly in the long run and at the same time possibly risk companies to lose their confidential information to their competitors. In the first few years of the implementation, there will be possibly a scarce of supply for SME accountant to cater to the demand of the task in the market. Capacity and capability building in human capital and resources may become a problem for the small entities. Number 3, other reporting and non-financial disclosure requirements. Contributions to the SMEs have argued that there will be more reporting requirements in the future from the public, stakeholders and also regulators once the Mpers are fully implemented. For listed companies, in addition to the financial statement that is compulsory to be prepared, the company also is highly encouraged to prepare other types of reporting. So, it is believed that similar demands will be pushed for SME to have all this kind of reporting. That's all from me. I'll pass this to the next presenter.
Thank you, Liana. Next, I am going to present about a few significant differences between MFRS, Mpers and Mpsas. The first one is regarding the presentation, policies, estimates and error. Mpers framework has some minor adjustments such as replacing balance sheet with statement of financial position and income statement with statement of comprehensive income.
Mfrs requires the third statement of financial position to be given whenever a policy change is applied retrospectively, when an error is corrected retrospectively, or when line items are reclassified retrospectively, while Mpsas and Mpers do not require this. Next is regarding the business combination. Expenses that are incurred in connection with business combination are capitalized in Mpers. Mfrs requires that these expenses to be written off to profit or loss, except for transaction costs of issuing financial instruments in a business combination, in which the transaction costs are included in the initial measurement of those financial instruments and are not capitalized in Mpers. Next is regarding recognition, derecognition, measurement, and hedge accounting. The principle of recognition, derecognition, and measurement prescribed in Mpers for basic financial instruments are generally the same as those in Mfrs 139. However, Mpers is a simplified version in that it does not contain rigid or rule-based classification requirements. Next is regarding the classification of financial liabilities and equity. The other classification requirements are comparable in both Mfrs and Mpsas reporting framework, while Mpers gives additional guidance on share issuance, capitalization, and share splits. It also specifies how shares should be valued based on their fair worth of cash, other assets, or resource received or owed. Mfrs does not demand this, and the measurement of shares issued in a transaction is depend on the facts. Next is the disclosure about financial instruments. Compared with Mfrs, Mpers does not require disclosure of these following items, such as an entity's risk management objectives, policies and strategies, including hedging policies and strategies. The second one is the disclosure about the market risk. The third one is the fair value measurement levels and transfer between the levels. Next is the sensitivity analysis of variable used in the fair value measurement. The fifth one is the sensitivity analysis of market risk. And the sixth one is the disclosure about the quality of receivables, such as concentration of credit risk, aging of receivable, and impairment losses. Next is the differences between the standard on assets. The first one is PPE. For example, Mpers and Mfrs will measure the initial measurement of the assets at cost, while Mpsas will measure at cost only for exchange transaction and measure at fair value on the date of acquisition for non-exchange transaction. Next is regarding the intangible assets. In Mpers, all intangible assets are thought to have a finite useful life. Over the useful life of an intangible asset, or if the useful life cannot be estimated reliably, they will use the management best estimate to figure out how long the asset will last. Still, it can be more than 10 years. On the other hand, an intangible asset can have an indefinite useful life in Mfrs and Mpsas. In this case, there will be no amortization on the IA, but it must be tested for impairment at least once in a year. Next is regarding the investment property. One of the difference between the treatment of these three standards are for initial measurement of IP. Mfrs and Mpers measured at cost on initial recognition, and transaction costs should be included, while for Mpsas, for the exchange transaction, it will be measured at cost, including transaction costs, while for non-exchange transaction, will be measured at fair value as at the date of the acquisition. That's all from me. Next, I will pass the presentation to Wirdahani.
Thank you, Alicia. Next, I will explain about the status application of standard by entities. The application of standard can be made by the entities for the first-time adoption and when there is transition from one standard to another. First, I will talk about the Malaysian Financial Reporting Standard. The Malaysian Accounting Standard Board (MASB) had issued Mfrs 1 first time adoption in Malaysian Financial Reporting Standard, which was applicable for annual period beginning on or after 1st January 2012. The Mfrs 1 is equivalent to IFRS 1 first time adoption of International Financial Reporting Standard as issued and amended by the International Accounting Standard Board (IASB). It is enacted by MASB for the entities to apply the standard for the first time. In Mfrs 1, there is stated that an entity's first financial statement are the first annual financial statement in which the entity adopt Mfrs by an explicit and unreserved statement in those financial statement compliance with Mfrs. The financial statement in accordance with Mfrs would be the first financial statement of the entity based on the standard if the entity first did not presenting financial standard for previous period of the entity. Second, the previous financial statement under requirement that are not compliant with the standard. Third, the entity prepared the financial statement for internal use only and not for the owner and external user. Fourth, the entity prepared a reporting package in accordance with Mfrs for consolidation purpose without preparing a complete set of financial statement as defined in Mfrs 101, presentation of financial statement. Next, on the transition of another standard to Mfrs. An entity shall prepare and present an opening Mfrs statement of financial position at the date of transition to Mfrs. The transitional provision in other Mfrs apply to changes in accounting policies made by an entity that already use Mfrs should apply to first-time adopters transition to Mfrs except when there are exemptions. As mentioned in paragraph 13 until 19, an entity's opening Mfrs statement of financial position shall recognize all assets and liabilities that the recognition is required by Mfrs. The entity shall not recognize items as assets or liabilities if Mfrs do not permit such recognition. Third, reclassify the items recognized in previous GAAP as one type of asset, liability or component of equity into a different type of asset, liability or component of equity in accordance with Mfrs and apply Mfrs in measuring all the recognized assets and liabilities. Other than that, the changes in accounting policies used in the previous GAAP would be different and the result would be in some adjustment. Therefore, an entity shall recognize those adjustments directly in retained earnings or any appropriate category at the date of transition to Mfrs. Next slide, I will talk about the Malaysian Private Entities Reporting Standard Mpers. The first time adopter to Mpers shall apply the Section 35 transition to Mpers. There is stated in Section 35 transition in Mpers that an entity's first financial statement that are in accordance with this standard are the first annual financial statement that the entity make an explicit and unreserved statement in those financial statements of compliance with the Mpers. Therefore, the financial statement should be prepared in accordance with this standard if the entity not present financial statement for their previous period, the entity present its most recent previous financial statement under national requirement that are not compliant with the Mpers. Third, the entity present their previous financial statement in accordance to other standards such as Mfrs, Pers, and FRS. Other than that, an entity's date of transition to Mpers is the beginning of the earliest period of which the entity presents full comparative information in accordance with this standard in its first financial statement based on Mpers. For the transition to Mpers standard, on its date transition to Mpers, an entity shall recognize all assets and liabilities whose recognition is required by the Mpers. Second, shall not recognize any item as asset or liability if the standard does not permit such recognition. Third, the entity should reclassify the item that is recognized under previous financial reporting framework as one type of asset, liability, or component of equity into a different type of asset, liability, or component of equity under the Mpers, and apply this standard in measuring all the recognized assets and liabilities. The same with the transition to Mfrs, the changes of accounting policies that entity use in adoption of this standard should be different from those that is used in the same date using the previous financial reporting framework. So, the adjustment arising from the transaction, other event or condition before the date of transition to this standard shall be recognized in retained earning and other category of equity at the date of transition. Lastly is the Malaysia Public Sector Accounting Standard Mpsas. Based on the Mpsas 33 first-time adoption of accrual basis Malaysian Public Sector Accounting Standard, an entity shall apply this Mpsas when it prepare and present its annual financial statement on the adoption of and during the transition to accrual basis Mpsas. This applies when an entity first adopts accrual basis Mpsas and during the transitional period allowed in this Mpsas. It does not apply when the first-time adopter stops presenting financial statement in accordance with the requirement, have been presented them as well as another set of financial statement that contain an explicit and unreserved statement in compliance with the accrual basis Mpsas. Second, presented the financial statement in the previous reporting period in accordance with the prescribed requirement, and those financial statements contain explicit and unreserved statement compliance with the accrual basis Mpsas, even if the auditor modify their audit report on those financial statements. On the transition to Mpsas, an entity's transitional Mpsas financial statement are the annual financial statement in which an entity's transition to accrual basis Mpsas and adopts certain assumptions in this Mpsas that affect the fair presentation to the financial statement and its ability to accept compliance with the accrual basis of Mpsas. An entity transitional Mpsas financial statement are those financial statements where the entity transition from another accounting basis, such when the entity prepare the most recent financial statement in accordance with the Mpsas financial reporting under the cash basis of accounting. Second, the entity present the most previous financial statement in accordance with the requirement that are not compliant with Mpsas and prepare in accordance to Mpsas but not contain an explicit and unreserved statement that they comply with the Mpsas. Fourth, prepare financial statement in accordance with Mpsas for internal use only without making them available to the external user. I think this is all from our group. Thank you.